Hi, and welcome to your monthly market review. I'm your host, Nick Rowert, joined today by Rusty Vanneman. Rusty, welcome.
Hey, Nick.
So let's jump right in.
Yep.
CLS has increased its exposure to Europe. Is that economy ever getting better?
We have been adding to Europe for a combination of reasons. We've been adding because valuations are attractive. Expectations are low. And when expectations are low, usually the market can do pretty well. Let's talk about the economy a little bit. The economy is not great. I mean, probably the best you could say is sluggish, and some of the key economies might be sliding backwards a little bit.
Okay.
But what's really, really interesting about stock market returns and the economy is it's really about the change in expectations. And so if the economic data is coming in better than what investors thought it would be, that can usually be a good thing for the market. And in fact, we're seeing that now. So there is an economic statistic called the Citigroup Economic Surprise Index, and basically it looks at the economic data, how it's coming in relative to expectations, looks over like the last 3 months, and in short, the data is coming in better than what people expect. Now, we pay for a lot of different tools and research, including BCA Research is a third-party provider. So we do a lot of this research ourselves, but in this particular case, they've looked at all the times that the numbers come in better than this, like it is right now in the Citigroup Index, and look at stock market performance, and usually the stock market does pretty well when this starts to happen, and we're seeing that now.
Okay, well that's good. That's good to know then. Now let's. You mentioned relative valuation earlier.
Yeah.
Let's talk about that. So obviously, relative valuations look good for Europe. Do relative valuations really work?
Yeah, we think they do.
Okay.
We think they do. So when we say relative valuations, we do talk about this a lot. And so basically, a valuation means how much do we pay for a dollar of dividends or earnings or cash flow or book value or whatever it may be. And we look at this stuff all the time. We bring it all together. And again, in short, the relative valuations for Europe look a lot more attractive than they do for the U.S. Depends on the metric. It could be a little bit better or it could look a whole lot better. Either way, it looks better. And therefore, we think that European equities are priced for better returns in the years ahead. So getting back to relative valuations, do they work? Well, portfolio manager Grant Engelbart here, he's run a bunch of numbers, and he looked at just using relative valuations for U.S. sectors going back 20 years. And again, the long story short here is it adds about 1% in value per year if you favor those sectors that have the better relative valuations and sell those with the higher relative valuations. So again, yeah, we think it works.
Great. Well, that's good information. So let's move on then. So we know that asset class performance is cyclical. Is that what happens with money managers as well?
Yes, it is. Everything is cyclical. The expectations I talked about before, valuations I just talked about, and you can even see a cyclical pattern in money manager returns. I've done this research in years past. There's a lot of other outside research on this that shows that 3-year relative performance, which, by the way, I think is probably the single most important number that a lot of people use to pick money managers, not just individual investors. We're talking institutional investors as well. You can go to a sophisticated investment committee who's got all the great data, and still a lot of times they'll pick the money manager with the best 3-year number. So anyway, but the thing is, the data shows that there's a negative correlation between 3-year historical performance and future performance, which means you really should be looking to buy managers when it looks like they're out of favor. And the key here is to find managers who are disciplined. That are sticking to their style of investing, because like everything, the style of investing are cyclical. If their style of investing is out of favor, you know it's going to come back.
Right.
So you don't sell that manager when they're out of favor. You actually would tend to buy them. So it's cyclical, just like valuations and just like expectations.
So just patience.
Yep, that's the key.
Okay.
Absolutely.
Well, thanks for the insight today.
Yeah, thanks, Nick.
Well, that'll do it for this month. As always, thank you for your time and trust in CLS Investments.